Hi, this is John McPhee here with a strategy on income protection for retirement planning. You look at the map of the United States on the screen here, you'll see that a lot of people in the United States are living on a lot less money than they were making during their working years when they actually retire. There's a few different reasons for that. For one, people aren't saving as much. Returns in the market are down over the last several years, and people are living longer, so they're more concerned about running out of money before they die. It used to be that financial planners would talk about the 4% rule. That would mean that you would add up all your savings and investment account balances and take about 4% of the account value as an annual income for 30 years without worrying about running out of money. Well, with people living longer and market returns down today, that's no longer a reality. A recent study on sustainable withdrawal rates showed the actual sustainable withdrawal rates anywhere from about 1 to a little over 3%, depending on how aggressive and how much risk you are willing to take in the market. Well, a lot of people aren't willing to take a lot of risk in the market during their golden years. And so the answer comes down to the fact that people have to save more to make up the difference. And it is more efficient to save more than to try and plan on getting a higher rate of return. Robert Shiller says that Americans right now save about 4 to 5% of their income, and they earn a 0% rate of return on it over their lifetime because of fees, taxes, inflation, penalties, and things like that. So where we save is very much important as well. And this is where different financial planners and advisors take different tracks with their clients. Some advisors push their clients to the investments only approach. Sure, they might have a diversification of different investments, stocks, bonds, mutual funds, and a lot of different things, but they push them all to an investment-based portfolio. Other advisors tend to push their clients into a life insurance approach and try to maximize life insurance cash values and do nothing else so they don't have market risk. The real answer is usually going to be a balance somewhere in between. And for the investment side, we're not necessarily talking about traditional investments if you do not want to be exposed to market risk. A lot of people have opportunities in their own lives or in their families' lives to finance things that they're already financing and recover the cost of interest on those things before ever looking outside for other types of investments. So let's take a look here at an investment portfolio and the gentleman who has some life insurance. Let's see how the income protection can be maximized with this strategy. So for our example here, we have a gentleman who's age 65. He has an investment account balance of $852,000. His Social Security is going to be $30,624 a year, increasing at 2% a year to keep up with a little bit of cost of living. Inflation's probably a little bit higher than that. Yes, I know, but we're going to use 2% for this example. Now, the income needed here is $100,000 a year. So you can see right away that he has about $70,000 a year that he's going to need to take from his investments. And for the investment account, we're using the S&P 500 real returns from 1981 through 2015. And the real returns are as opposed to the average rates of return. You can look up our video on average versus actual rate of return to see why we would want to be using the real rates of return here. So here's the picture of the investment account balance. You can see it starts out at over $800,000 and it dwindles down to zero by age 83. The red arrows represent the market corrections in here, and here's the first step of the income protection strategy. Every time there's a market correction, he is also taking income from this investment account. So that it's what's called a double dip. He takes a hit in the market and he takes money out of the account. So when the market bounces back, it doesn't grow on the money that he just took out in that down year. So one of the things that can be done to maximize the investment account balance is to take income from some other source during down market years. This is called a volatility buffer by some people. So if we're able to do that, then the investment account balance looks like this. 3 times from the time he's 65 to the time he's 83, 3 times when the market is down, the little red arrows, we take income from other sources. That means we take $242,000 from other sources by age 83. But the investment account balance now is still $836,000 by the time this gentleman's at age 83 instead of 0. So we just maximize the investment account balance increase it by about $600,000 over these few years. That'll be another few years of income for this gentleman. All right, so then after age 83, there were some market corrections right in a row. This is actually the dot-com bubble that you see, the 3 right in a row, and then the last red arrow right before he's 93 doesn't affect him all that much because he didn't have that much left in the investment account anyway. That red arrow, though, was 2008. So where is the account where he has these other funds? Well, it could be a few different things. Let's take a look. He has this investment account balance of $852,000. Let's say he was put an extra $15,000 a year for the last 25 years. So that was from the time he's age 40 to the time he's age 65, into either bonds that are earning 3% a year, and that's net after taxes. That would give him an account balance of $546,000. Or he could put it into participating whole life insurance policy premiums. His approximate cash values at this time would be $623,000 to $668,000, and a death benefit of over $1 million, about $1.3 million. So we can see right here that the participating whole life insurance policy is ahead. If we took everything out of the policy right now, he's paid $375,000 in premiums. That's the $15,000 a year times the 25 years. If he took everything out and paid taxes on the growth beyond the $375,000, he'd have right about what the bonds have at this point. So now let's take a look at the annual income for this example. He needs $100,000 a year starting out at age 65, growing at 2% a year until he's 100. Well, if he just takes from the investment account first until it's depleted at age 83, and then he switches to the bonds and reduces them to zero, then he's going to be out of money at age 93. So it delays it by about 10 years, 9 or 10 years. And then he just is left with Social Security income. The alternative then is we could take and do an income balancing with bonds, the bond account. So he takes from his investment account, except in down years in the market, and then he takes from the bond account. And as we saw earlier, that extends his income by a few years. You can see that now, instead of running out of money at age 92, 93, he doesn't run out of money till age 96. So what can we do then with the life insurance method? Well, if we put that $15,000 a year into participating whole life insurance policy from the time he's age 40 to age 65, and then we stop premiums after that point. So he pays no more in premiums. And then we take from the investment account, except in market down years, and in market down years we take a withdrawal from the participating whole life insurance policy for the income. Then he's able to continue his income out until age 90 this way. And then at age 90, what we did is took the remaining balance in the life insurance policy and switched into an annuity, put what was left over into his investment account. Let's take a look at how that looks. That's the income is the green line now. You can see his income stays up with this example all the way through. So what exactly happens here? Here the participating whole life insurance policy cash values and death benefit. At age 83, there's $910,212 to a little over $1 million in cash value. And what these numbers, the range on these numbers, the number on the right shows what the insurance company is projecting based on what they're currently doing. The number on the left is a projection of what could happen if they don't do quite as well as they're projecting on dividends. So at age 90, there's $772,000 of cash value left. And you can see the corresponding death benefits for age 83 and age 90 down below. Now, the bond account values, on the other hand, age 83 is $618,000, age 90, $391,000. So what we do with the participating whole life insurance here is we take the $772,000 and we put $500,000 of that into an annuity, and then the remainder, the $272,000, pays taxes of $81,600, and that leaves us with $190,400 left over. He needs some of that income in the year that he is 90, so he takes $113,000 of that as income, and then the remaining $76,000 goes into his investment account. So let's take a look at the investment account now. And you can see that his investment account goes up to a peak of $800 and some odd thousand there, and then it comes down to $230,000, and then we add in that $76,000 from the whole life insurance policy. It bounces back up, and then the annuity is covering a lot of the income, so we're not taking as big of withdrawals from the investment account anymore. we're not as exposed to the market risk. And so the investment account actually starts going up again, depending, of course, on the market performance. You can see the 2008 is in there, the last red arrow, after we add in the amount from the participating whole life insurance policy. Such a powerful example from running out of money at age 92, 93 to now not running out of money and having your income increase the same level as it was before, and have an investment account balance that's growing for some extra spending money or emergency medical expenses. Doesn't get better than that. We couldn't have accomplished it any other way. It really shows the power of the income protection strategy at work for you. So now I want to give you some bonus resources. You can either click on the link that will come in the video right up here, or if it doesn't come in, I'll put the link in below this video so you can click to claim those resources. You'll be able to access calculators where you can work with your retirement income projections, see if your Social Security might be taxable. We also have an attorney interview as part of these resources, and a couple reports that I mentioned earlier about the sustainable withdrawal rates, and one of them also talking about using life insurance and annuities to protect your income in your future golden years. The best time to start planning is now, so make sure you claim those resources and don't wait till it's too late to implement this type of strategy for protecting your income in the future.
Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.